So welcome everyone, welcome to this another episode of the Deal Final Corner. So this is your weekly property talk show brought to you by Property Filter and hosted by myself, Guillaume Black, your favorite Frenchman, CEO and co-founder at Property Filter, so the UK's highest rated platform to find deals. And as you know, we're on a mission to empower our property investor and deal sourcer members to find another 1,000 deals this year, thanks to the Property Filter blueprint, where I should have a better target because there's been 3,000 and a bit in the last 12 months. So we need to crank this up a bit. So the purpose really with this Deal Final Corner is to give you more and the best of the available resources by inviting expert guests who will share with you the latest and most current strategies, tactics, and secrets about what actually works right now in terms of finding and making deals and the reality of systemizing and running a high-performance business in property. So really is my pleasure to reintroduce my good friend Jay Howard on today's Deal Final Corner. So Jay's been working within the property industry and sector and trading property since like more than 20 years, since the beginning of the millennium, right? And at that time, he was advised a family trust of almost 3 billion. Increased the net value of the trust from 2.7 to 3.3 billion at the time. He's been an auction manager at London property auction companies for quite a while, and he's been back in the days and traded properties where he's made as little as 400K on a single trade, or even more sometimes. So Jay's got 3 degrees and used to learn dead languages for fun. So we'll have lots of allegories and things, I'm sure, today. We usually have quite some fun here. It's been kidnapped and stabbed, held at gunpoint. He's got lots of stories to share and an amazing human being, to be fair with you. So he's here to talk about how amazing auctions are and can be, and especially right now in this market. So we see on Property Filter there's twice more properties available in auction right now than they were just a year ago last summer. And then who better than Jay, who's wrote the book, before the hammer falls, which for me, if you've not read it, you are missing out. If you are interested in auction or not, I believe it's the best property book out there, and the one that articulates best how to do due diligence and things like that. So he really knows his stuff. He's coming back after a while. So we've been we've done one episode some time ago, and we had lots of good fun. And today we're going to talk about auctions, horror, and success stories. And Jay is going to share the unfiltered reality about what's happening right now and what can go really wrong in auction rooms. He will share no-nonsense advice. So expect some good frank speaking, between the two of us, how to navigate auctions like a pro, avoid taps, and actually walk away with making a profit. So you'll see the talk will be there'll be zero sugarcoating, brutally honest, and we'll have lots of fun, I'm sure. And Jay, as always, will share some powerful truth every investor needs to hear. If you are interested in auction or not, by the way, it's quite, his knowledge is quite broad. So, and for everyone who's attending today, so really, really pleased to share with you, Jay's very, very kindly pre-recorded a course which is called How Not to Get Fucked at Auction, which we are getting exclusively for the Property Filter member for free for the coming few months. So yeah, make sure we make the most of that. So I'm really looking forward to the presentation, the conversation with Jay again. So please join me and give Jay a massive Property Filter welcome. Over to you, my good friend.
You have to be one of the very few people that would introduce me like that. It's fantastic. Thank you very much. Love spending time with Guillaume and the Property Filter guys. We've had Guillaume out to Portugal a couple of times, and what happens in Portugal stays in Portugal, but those are normally really good events. But let me see if I can share my screen. This one. And then I can click present, and yeah, there we go. Can everybody see my screen? Is that
awesome,
coming through? Excellent. So yeah, no, fantastic. Thank you for having me back. So these are technically the 3 things that we currently do. So Property Auction Hunters is our YouTube channel. We're releasing weekly content there. There's a whole back catalogue of videos talking about auctions, how to access auctions, looking at specific deals at auctions, and how we basically go through things. We love our due diligence. So that's a big part of what we do. Hammered is, we could kind of think of us as auction brokers. Clients come to us and we position their properties in whichever auction is going to be best to make sure that they get the best price for their property. And Don't Get Fucked at Auction is the new pre-recorded course that we put together that we will be offering to you guys for free, free until the 30th of September. We're really excited about it. We've had a little bit of a pre-launch and people seem to be getting on board with it quite nicely. So it's all about just kind of getting good, valuable knowledge and experience out there just to make sure that people can approach auctions in a very confident and safe way. But yeah, let's get started. So I'll be covering today how to identify deals at auction. And essentially this is going to break down to, if you're looking at things that everybody else is looking at, you're always going to be disappointed at auction. You're always going to be outbid and you're just going to think it's a waste of time. So I'll be showing you how to identify deals at auction and then how to proceed and make those deals happen. 2, it will be auction to open market trading. So that's when you buy something at auction to flip into the open market, and then open market to auction. So that's something that you find on the open market that's just cheap. The agents have done quite a few price drops, as you'll find on the Property Filter platform. That's one of the key metrics. And you just think, actually, it's not being marketed well. I can put it into auction. I'll get more eyeballs and it will sell for more. I always like to do a little bit of a tease around underwriting because it's something really nobody actually hears about or knows about. And if they do, they expect it to be something that isn't, or just use it as kind of like a free money thing to do. And that's not really the way to treat it. And last is some basic information about the Don't Get Fucked at Auction course with a link. But I think Guillaume and the guys at Property Filter will send you a link and everything to give you access anyway. So let's get this thing kicking off. So is it a deal? Let's say you find a property at auction or you're going through a catalogue. These are the things that you need to look out for. So it requires a little bit of market knowledge and experience. And what we recommend is focus on 3 or 4 auctioneers and just watch their catalogue for half a year, which is probably going to be about 4 to 5 auctions for some of them. What you're looking for is you're looking for the stock that they get, that they market well, and that sells very well. Like a price where you think there's no way it's going to sell that price. You want to be looking at those. You want to go, right, this is where I sell that stock. And you want to be looking at the other assets that they have that don't sell well. And then maybe on one of the other auctioneers you're paying attention to, you can see they sell that type of thing well. So then you buy it from the auctioneer that doesn't perform well, and then you sell it through the auctioneer that does perform well. And we call that auction arbitrage. That's taking an asset from one auction and arbitraging it into another auction. So identifying which auctioneers have strong links to a certain area or strong links to a certain asset class. You know, there are some auctioneers that are very good at commercial and there are some that are terrible. So if you're looking at buying commercial for commercial yield, for SaaS, for commercial to residential, you want to be paying attention to the auctioneers that always struggle with the residential. Now, the other thing is, let's say the auctioneer is based in Manchester, but they're selling a property in Kent. Okay, that's really important because what are the chances that a Manchester auctioneer has an active live database for people buying and selling in Kent? It's rare, it's random, it's not going to get the best price. So sometimes identifying what the auctioneer is and the location of the property and seeing actually how fluid that property is in that catalogue is going to be something that you want to be paying attention to. So location is really important. Price. So price is fantastic at auction. It's even better if it's priced wrong. What do I mean when it's priced wrong? What I mean is it's priced too high. This is something you know is going to go unsold. Like nobody is paying that money. These are ways to get deals. When it doesn't sell and there's a price issue, you may have to pay attention to the auction. Maybe it gets relisted and the price comes down and down and down. But essentially what you're looking at is somebody who instantly isn't motivated by price, but because the property keeps failing to sell, the price metric starts to kick in. And marketing. We're going to talk about marketing a little bit more in a minute. But marketing is very simple. And auctioneers either do this badly or complicatedly. And it's the same thing with estate agents. So making sure that there are internal, external images, that there's a floor plan, that there's a video walkthrough, that it's actually being marketed properly. These are things that you are looking for. So on the left-hand side of the screen, we have an X. On the right-hand side of the screen, we have a tick. So you want to be buying in a deal in the situation where it's the wrong auctioneer, the wrong location, the wrong price, poor marketing, and finally the legal pack. Now, in order to make an offer on a property auction, you have to have a legal pack, but not all legal packs are created equal. So a lot of what you're going to see with these legal packs is maybe it's missing vital information. Maybe the information in there isn't clear enough. Well, if you can identify those issues that are putting buyers off and then rectify that legal pack issue, putting a proper pack, you know, the EPC, the lease, the title documents, the tenancy details, all of that stuff, a couple of certificates, you know, the windows, the, you know, if it's a tenanted property, for instance, residential, maybe it's worthwhile putting in the fact that they've got the boiler certificate and they've got all these things, and you know, it's compliant from a letting perspective. People aren't doing that yet at auction, and we're starting to recommend to our clients, or at least have been for the last year, to put the compliance documents, if your property is residential and let into the legal pack. It will make residential investors more comfortable with that tenant, right? So remember, you're buying on the X and you're selling on the tick. So if you're buying from the X, you want to be selling in an auction where it's a green tick, where the location matches, where the price is competitive and it's getting people to perform, where you've absolutely nailed the marketing and the legal pack is just perfect, right? So this is how you identify if something's a deal or not at auction. Now, this is like absolute perfection. If not everything on the left-hand side on the cross is red ticked, red crossed, it doesn't matter. If the auctioneer is wrong, the marketing wrong, and the legal pack is wrong, you're probably still going to pick up a good deal, even if the location and the price is right. You know, if the price is wrong, but the marketing, the legal pack, the location, and the auctioneer is right, you're probably going to do a good sale at auction. You know, you just have to balance things out. Is everybody clear and happy on that side of things? Okay, cool. So next is a case study. I love this case study. There was a guy who was in our auction buyers club, I think for just under 2 years, and he had the ability that even when we went through auction catalogs and we're like, okay, there's nothing very interesting here, he'd pull something like this out. He'd just pull it out of thin air. So you can see on the left-hand side, this is a property in Cookham. It's an arcade, which is basically a multi-let commercial building. There is a flat above, and there is a cottage to the side that kind of goes round to the back, and a little courtyard. He bought this at auction for £814,000. Now, he basically took it from one auction and split it into the individual parts. So you can see the top one on the right hand side is Roseley Cottage. That was the cottage that he sold. That sold pre-auction. The Roseley flat, which is the part above, he sold at auction for 220, and he sold the arcade for 385. So he bought it for 814 and he sold it for 980, and he did that within a few short months. So his trading profit on this, if you excuse some of the costs, bear in mind he bought this on commercial stamp duty because it was all under one thing. So the stamp duty was minimalistic compared to if you were buying the cottage and the flat separately. And by just having the vision to separate it out, because these are 3 different buyers, the reason he was able to buy this so cheap is because it's rare that somebody's going to want a cottage, a flat, and an arcade shop, right? But there are people that are going to want the arcade. There is somebody who's going to pay more money for the flat, and there's someone who's going to want to live in the cottage. And those individual buyers are going to contribute to the fact that this is going to be selling for more money. That was a really impressive deal. We actually helped him kind of trade that and sell that out, which was really interesting. So next we have auction to open market. and I've got it here. It says it's flipping good, because essentially that's what you're doing. You're flipping, yeah. So it's looking at what flips well at auction, what flips well from auction to open market. One of the things that we always advise people look for is assets that, generally speaking, aren't really prime auction stock, right? So you wouldn't take a burnt out house from auction and put it on the open market. It's the wrong stock. You want to be buying a burnt out house from the open market and sticking it into auction or off market. You'll make crazy money with a burnt out house. What you want is people who have been looking to sell their property, normally flats or houses, for a long time. Maybe there's a problem with them getting the mortgage for their buyers. Maybe the agent is just a poor marketeer. Maybe the price is wrong, whatever. So these are normally people who've kind of lost faith in the traditional estate agency selling method, right? And they put their property into auction. Now, these could be flats or houses that are just in okay condition. Maybe it needs a 5k thrown at it, change a carpet, paint a room, light touch, very, very, very light touch stuff. But it's the kind of thing that if you can buy it at auction cheaper than what they were listing it on the open market for, you as an investor or someone that does flips on a regular basis instead of a homeowner, you would be able to say, right, I could dress the property up like this. I can make sure there are better pictures. I can make sure there's a floor plan. I can try and resolve whatever the mortgage issue is, if there is anything at all. And those are the perfect kind of properties that you can flip from auction to open market. And we normally say here, less is more. And it really does matter. There are so many people that go to auction looking for complete hovels, right? These are the kind of things you see on Homes Under the Hammer, where it needs a £50,000 refurb and it came in under budget and it only took them 6 days and it's added £400,000 to the value. No, the stupid shit they say on that show. But you don't need to do that. Some of the best opportunities you find at auction for flipping is a property that's in near perfect condition, but the sellers have been motivated by something. You've been able to pick it up cheap, and you have the luxury of time to be able to put it on the open market to achieve the best market value over time. That's essentially what you're looking to do. So in a situation like this, doing less physical work to the property is ideal, right? So one thing that you want to do is, when you're structuring the flip, you need to do it so that it doesn't flop. A good friend of mine called Oliver, he's a property trader. He's quite a unique property trader insofar as a lot of property traders don't go to the properties that they buy. I'm one of those. I've been to maybe a third of the properties I've bought. Most of them I've never even seen. I've probably never been on the road that they've been bought on or sold on before. It's not a responsible thing to do. It's just how I work. But Oliver would go to every single property and he'd be buying the Homes Under the Hammer crap, the things that are like, there was a hoarder in there, or it was part burnt down, or, it was let out to a tenant who was subletting it to, half the Ukrainian army, that like a whole thing going on. And he would go in and it would take him 2 or 3 days by himself, because he's a lunatic, and he would clear it. So he'd get a skip, he'd empty the entire building out. He'd go in with so many bottles of Dettol. He's got a hazmat suit. He's got a gas mask for the fumes. He's got a real professional setup. So he'll clear it and he'll clean it. He puts air fresheners in there. He leaves the windows open. He gets a dehumidifier. He does everything. So he just takes it back to, not taking it back to brick, but just taking it back to empty, and where someone can look at it and go, right, I can put my sofa here. A tenant would pay X to be in here. I just have to change the carpet. He wouldn't change carpets. He wouldn't change kitchens or bathrooms. He would just do a smarten up, but like a deep clean. And the next bit is rebranding it. So sometimes these properties sit on the market for a long time and people know, oh, that's the hoarder house where that person lived there for 30 years and it probably smells like cat piss, or whatever the story is, or there were rats, or there were this, or there were that. And there's always a story with these things. So you need to rebrand it. And what he does is he bought himself a very expensive camera. You don't have to do this. You can hire someone to do this. A very expensive camera, and he would take professional pictures of every single room. He'd do a measured floor plan. He's got himself a drone. I think he convinced his wife that the drone was for work. So he's got this drone. So now most of his properties you can see from above. So you can see the roof, you can see the plot as it stands out. He does everything. And then he does a video walkthrough all the way through the building. And then what he does is he hands that package, that marketing package, over to the auctioneer and or over to the agent. He does all the work for them. And that's what I mean. There is very little cost to doing most of that, apart from your own time, going in there, clearing it, cleaning it, and rebranding it. And again, it's keeping these things kind of simple. There is an expectation, I think, for investors to go, right, I bought it for this, I now need to add some value to it. And people normally think if I'm adding value, I have to spend money, right? So you think, oh, maybe I'll just change the kitchen and put new flooring down and that's it, Okay, that could be close to 10 grand. You don't need to do that technically. If you're flipping, it's not necessary. And one of the things with auctions is you're looking for speed and turnaround of deal. So this isn't the case of doing a deal like this isn't to get the maximum return. It's to get a quick, easy return with minimum cost and minimum effort. Yeah, because you want to be able to say to yourself, if I'm doing a full refurb and remarket and resell, how many of those can I do a year? 4, maybe. But if you're doing it this way, the way I've described, you could do 20 a year easily in the same time frame with less cost. The profit margin will be slightly less, depending, because you're not putting a great deal of physical labor and change into the property. But it's super quick and easy, and bridging enables you to buy from auction and flip into the open market very easily. So that is auction to open market flipping. And we're finding actually there's a trader, and he's quite unique in the way that he does things at the moment. He is only buying from auction, and he's buying from auction to specifically flip to the open market. And why that's rare is because most traders get things off market, put it to auction, or they buy it from one auction and sell it to the other auction in the way I've described to you earlier. But he is taking the slower route, which is auction to open market. He knows it's the slower route, but he knows it's the best return route because it's going to get him more money on the upside. So that's a good route for people to take. And structuring the flip so it doesn't flop. These are really important. I always tell people, if you are buying it from auction, you want to have access to the property between exchange and completion, right? And the reason you want to do that is you pretty much want to clear that property out before you complete. You want to clean it before you complete. So the moment you complete, you can list it on with an estate agent already done. It's about optimizing yourself so you're not having cost overruns. Obviously, the longer you hold a flip, it starts to flop because finance costs, because market changes, because of all of these things. So speed is definitely your friend. Next slide. So this is a great one. Again, this is somebody who's in our auction buyers club. And this is in the place Sevenoaks in Kent. And this was a huge property. And he had made a pre-auction offer, I think of, I want to say about 380, 390. This had been to auction. This was through Clive Emerson auction. This had been through their auction several times, and I think it was originally on the market for, I think, about £600,000. And over time, the price had come down. The important thing about this is it's a probate. And the person who passed away had lived in the property up to 2 years before passing. And the client on this one did no physical works to the property. It's obviously not showing the internal images, but just imagine it's a nice wood-beamed cottage in okay condition. And it was just an okay condition. So you have the stamp duty exemption here because it's probate. And he had bought it for 350, no stamp, just legals, I don't think there were any real fees in the special conditions, which is rare, but it's a probate, so that's fairly common there. And within 6 months, he sold it for 475. So I would say, start to finish, he is probably looking at a pre-tax profit of about £100,000 in 6 months. One of the things that I always kind of talk to investors about is, all investors are like, no, I'm buying to build a portfolio. I'm not thinking about selling anything. The idea of capital gains scares the hell out of me, blah, 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 blah. If you were to introduce trading or flipping into your strategy, maybe set up a separate vehicle for that, and have the SIC code for trading your own property, you don't pay capital gains on this profit. This is all company tax, that corporation tax. There is no capital gains for traders. Okay, and what you do here is, instead of trying to keep every single property you can, maybe this doesn't fit your investment criteria, but you know it's cheap and you know you can sell it for more, then why not sell it for more? Because the capital events that you create from trading will help you with a next deposit, paying down debt, doing a refurb, doing whatever. You can treat the trading pot as a pot of money that helps you achieve your portfolio growing goals. When I first started out in property, a friend of mine said one of the oldest methods he knows of building a portfolio outside of being royalty is the 3-2-1 model. For every 3 properties you buy, you keep 2, you sell 1. And if you're changing that, you can every 3 that you buy, you can sell 2 and you can keep 1. And what that does is it keeps you liquid. The major issue I think a lot of the investors have is liquidity issues. Refinance timings slow people down. Refurbishment timings slow people down. So trading and flipping is a really good way to make you nimble and make you profitable, reduce your reliance on expensive mortgages and other kind of costs. So that's my sales tip to get people involved in looking at the dark side of property. So instead of having a ton of tenants calling you up on a Sunday morning because they got drunk and lost their keys, you can just trade property. It's a lot of fun. So this was actually really good. The guy who did this deal came out to the retreat that Graham came out in April this year. And at that retreat, he stood up and said, he's just a portfolio builder. He said, I would only do a trade if it made me £100,000. And then he does this, which made him £100,000. And he's done 2 or 3 more, which have made him like 30, 50, 70. And it's getting to a point where if he carries on trading, the trading profit is going to match his income, because he's trying to get residual income from his existing assets up to £250,000. If he carries on trading, the trading profit is going to match his income return, his yield return. And that's really impressive. How that changes his whole investment strategy going forward is really cool. Make that sound less like a sales pitch. It's not. He's just very impressive. This is the most common way to trade. So this is finding something on the open market or off market, it's to trade tastic, right? So what normally happens here is, when you're doing your due diligence, some of the best deals we've found is we see something at auction and then we start doing our due diligence. We Google the full address of the property, we look on property data, we look on property filter, we look on EIG, we look on all of these places, and then we start seeing properties that are on the market. You go to Rightmove, you go to Zoopla, you go to the Move market for a rough kind of valuation metric. You do all of these different types of things. And then you find a property 4 doors down that is £50,000 cheaper than the one at auction. You think to yourself, what's going on? There is something on the open market £50,000 cheaper than something that's in the auction. Well, that tells me instantly that either the auction price is wrong, or that property 4 doors down is supremely cheap. Obviously, you do some work and you figure out which side of that scale you fall on, but either that property is really cheap or the property at auction isn't going to sell. So you've gone from 1 lead to 2 leads, 2 opportunities to buy now. And that's what's brilliant about this, because on your journey to do one deal, you trip over another. And not a lot of people are kind of cognizant of this. They're just looking for comparables. And if the numbers match, great. And if the numbers match, okay, not great. But then nobody questions why it's not matching. Is it a pound per square foot issue? Is it a like-for-like comparable? Is the condition the same? What's the opportunity here? Because there is an opportunity, and that's what traders do. They take opportunities and they bring them to the open market, and they help investors, developers make money from them. So what trades well to auction? Well, the easy stuff, the burnt out properties, the flood risk properties, insurance, rejected properties. Hoarder properties are fantastic. Short lease flats are fantastic. Properties that have got planning permission are great for auction. Even if it's just a change of use under PD, they do very, very well. Those types of properties always do well because it's very clear where the value lays, right? If it's just a 3-bedroom house that's a nice looking 3-bedroom house, it's not ideal unless it's in a perfect HMO area and it's outside an Article 4. The questions you need to ask yourself as to what the potential is from looking at it here to what we want it to be here. And really identifying those opportunities based on your skill set, your knowledge of an area, or your knowledge of an asset class is so vital if you're looking to access the auction world. So structuring the trade, this is something that not a lot of people are aware of. Can't list them all. There are at least 24 stamp duty exemptions and reductions that are only applicable to property traders. We've mentioned one already, the probate, right? In order to get that probate, not pay the stamp duty, you have to buy it. The person had to have lived it there in the last 2 years before passing away. You cannot spend more than £20,000 or 5% of the property value or whatever it is. And you have to be buying it for the purpose of selling it. That's trading. You can't buy a property and claim the stamp duty relief and then not sell it. You can't portfolio it. You have relocation stamp duty relief. You have part exchange stamp duty relief, which is why a lot of developers, some of the big ones like Barratt Homes and Red Row and people like that, that's why they offer people no stamp duty on the part exchange or to fund your stamp duty on the purchase of their property, because they're getting your property stamp duty free. So it looks like it's a big value add that they're offering you, but it's a sideways thing. It's a loss leader. It doesn't cost them anything. It doesn't gain them anything. You have uninhabitable. That's probably the one that's misclaimed on a regular basis, very regular. Uninhabitable doesn't mean it hasn't got a kitchen or a bathroom. It means it's falling in on itself, or it's radioactive, or there's a sinkhole that's opened up underneath it and you actually cannot live there. It's uninhabitable. Not, you can just stick a camper van outside the front and get on with your life. It has to be uninhabitable. And there are several others, some that are based on unique examples. So if you're structuring a trade, you want to make sure that you want to identify if there is a stamp duty exemption for you, right? You can't then hold this. It has to be sold. And then structuring it in smart terms. An EDC is what we call an exchange with delayed completion. So you will make an offer to somebody off market or on the market, and you'll exchange immediately. That's powerful. There is nothing more powerful in property than an exchange of contracts. You exchange, and then maybe you arrange a 12-week completion. That gives you 3 months, right, to tidy it up, to put it into auction, to run the sale, to do all of those things. And all you're really doing at that point is you have your deposit at work. You've exchanged. So maybe it's a 5% deposit, maybe it's a 10% deposit. At this point, you're not really factoring in the cost of lending. You're not doing anything like this. It's just an exchange. You're delaying the completion subject to the auction result. Yeah. And you can structure this as a back-to-back, and back-to-backing also gives you a stamp duty relief. So traders are very, very good at managing and mitigating the frictional costs of a transaction, because if you can manage and mitigate the frictional costs, you're increasing your margin over that. That's really important. And this is only really works if you're using auction either on the in or on the out. And that's essential because you need the guarantee of exchange. Right? How many times have you gone to an estate agent and the estate agent's messed you around, or you've gone direct to the vendor and the vendor's just messed you around and they keep pulling the plug at the 11th hour? Auction gives you that guarantee of exchange. That's super powerful. And if you're doing the trade, when I say, before I said less is more, right? On this one, less is more. And I've said here, less is always more. So let's say you buy a property open market that you're planning on trading into auction and you've paid £200,000 for it. You need to put it into auction, guided at 150 and reserved at 165,000. Now, if everyone is doing their maths correctly, which is probably better than I ever will, that is a £35,000 difference between what you're in contract for and what you're reserving it for. Now, why is less more? Because if you were willing to pay £200,000 for something, imagine what somebody is willing to pay for it once they see it at 150,000. You create an environment where bidding goes up and up and up and up, and it sells for 220, 230, 240, 250. We see it happen all the time. We do it, people in our environment do it. So less is always more. There is a big kind of warning sign here that this strategy has to fit in perfectly with your risk profile. If your risk profile, if you're very trepidatious or you have a very low risk tolerance, this is not the way to do things. But if you have a high risk tolerance, you trust your numbers, you trust the process, this is a great way to make very good returns in a very short period of time. Yes. Next, we have underwriting. I tend to leave underwriting to the end because most people don't know what underwriting is. It is so much fun to underwrite a property. You have no idea how happy it makes me if I underwrite a property. And what makes us unique as traders is actually, as traders, if someone came to us, our property's in auction, and said, oh, we'll underwrite it for X. If we're happy with X, we'll underwrite the property. We will let someone underwrite with us as well. So you all would have heard of underwriting in one way, shape or form, right? If you're getting a loan, your lender or your broker says, oh, it's with the underwriter, right? And what the underwriter doing is they're underwriting the value of your property. They're saying, is it worth X? That's what underwriters do. You would have heard it on the radio when you hear the car insurance adverts and, all, UK car insurance, UI, Lloyd's Bank underwrite everything, and you would have heard of it, but you won't have heard of it in terms of auctions unless you've read the books or you've watched the YouTube channel, you've done some other stuff with us. Underwriting, the best example I can give is, let's say a property is listed at £225,000. The reserve is going to be 250. So let's say you make a pre-auction offer and you offer them 250 to buy it out immediately. That 250 is rejected. The seller thinks they can get more. That's fine. So you say, well, actually, why don't I underwrite it at 250? So that means the minimum you get is 250. But every pound it sells for over 250, we will split the difference, just for mathematical purposes, 50-50. So if it sells for £270,000, I will make £10,000 and you will make £10,000, right? Does that make sense to everybody? So it's underwritten at 250, it sells for 270, the underwriter and the seller split the difference. It's like an overage, very simple. Now let's say it sells for 270, but the buyer at auction fails to complete. Okay, happens nowhere near as much as open market, but it does happen. What happens then is the sale reverts back to you as the underwriter at 250, right? So you still get the property for the price that you want it. So either you're making £10,000 or you're winning the property at a price you're comfortable with. There's no lose here. It's only win-win, right? It gets difficult when people get greedy. And you say, well, Jay, how do you get greedy with underwriting? I can tell you, but you have to promise not to do it. So I get everyone's promises, pinky promises from everybody. Perfect. Serena's nodding. I trust Serena. Thank you. Okay, pinky promises. So let's say you underwrite the property at 250, but in your heart you're like, I think this is worth 300. As it is, before I do anything, it's worth 300. So maybe I'll log on and maybe I will bid up against other people. Okay, because if I pay 270 for it, actually when I complete, all I'm paying is 260. I'm getting that 50% back, right? So now every pound that's being spent above the 250, you're only paying 50 pence of it because you're going to get that rebate. You're getting 50% of that pound back, which means it is now pound for pound cheaper for you and you alone to pay more than 250 against everybody else. That knocks all competition out the window. Things to focus on. A, when you underwrite, you have to put down a 10% deposit. B, when you purchase at auction, even if you've underwritten, you have to put down a second 10% deposit. So you'd be putting down 25k and then you'd be putting down 27k. And you'll be putting down £52,000 in total for a £10,000 return. Technically, all right? That's not bad. That's what, a 20% return? And you only have to kind of wait for completion 2 months. It's not the end of the world. There are some lenders I know who would love to get that kind of return on a regular basis. But that's a very basic way of looking at it. But what generally happens is people get the greedy, green-eyed monster, and instead of bidding it up to 70, they bid it up to 310, and they end up winning it at 310. And now you're thinking, wow, well, they're going to get 30 grand back, so they'll be paying 280 for it. But now 280 is too much money, right? So you have to, there are ways you kind of have to look at it to make sure that you're not overpaying. And it's a system that can be abused, which is why auctioneers tend to only underwrite with people that they know are responsible, that have done deals with them before, all of these different types of things. Or if we know the auctioneer and you're looking to underwrite something, we can put the offer forward. We do that for clients a lot as well. So that's underwriting. That's just a cheeky little thing that I thought you guys might like to hear about, instead of me just rattling on about how to trade or how to flip or what's good for buying at auction. So now we have the fun bit, and we called this "Don't Get Fucked at Auction." And it may sound like we're saying auction is a place where people get fucked. No. What generally happens is people make mistakes because they're taking action and they're doing things, perfectly legitimately. Everything makes sense, but the auctions include so many blind spots that people are making mistakes that they don't even know that they're making. So the course will give you a complete auction mastery. You will understand the auction process from start to finish, what is expected of you, how to perform best, and how to game the system to get the best out of everything that you're going to be doing at auction. 2, we will be covering 90% of the mistakes. Like, these are the most common mistakes that people make. That buyers make, and they're mainly legal mistakes and financial mistakes, but some of them are process-driven mistakes, right? There was a guy who I spoke with recently. He'd registered to bid on a property at an auction, and they'd registered him on the wrong property. Then he went back and said, "Oh, can you register me on this other property instead?" They said they would do it. They didn't do it. That meant that he couldn't bid. Right? And the property sold for £50,000 less than his maximum bid. So he's lost out not only on the deal, but there was a chance that he could have won it for far less than his maximum bid. Now, in this course, there are ways to make sure that how to behave to make sure that you get registered on the right lot, you're able to bid, your preparation has to be on point. So it's kind of covering off those kind of issues. It also covers off things like bidders bidding against themselves. I was watching an auction 2 weeks ago, and I think there were 6 bidders. It was an online auction, so you can actually see the bidder number and the bidder thing that comes up. And I was looking at it, and bidder 5 bid, I don't know, 265, and then 30 seconds later, bidder 5 bid 267. So that bidder, even looking at the screen, seeing that they were the very last bid, they still bid against themselves. So it's about becoming aware of these things, making sure you have your due diligence done, you've got your AML set up and sorted, you've got the card for them to take the hold so you can register to bid, and you don't leave that to the last minute. So all of this information is on the course. It's laid out in bite-sized chunks, and it runs through the whole process. The idea here is also we'll be sharing the strategies that we use, not just the ones I've given examples of here, but actual case study strategies that we use, our clients have used, members of our club have used in order to give you the upper hand over bidders. And that's not just underwriting. I mean, underwriting is a really cool way for that to happen, but that's not the only way you can do it. I think we've got some time for Q&A. I'll leave the link up there. I'm pretty sure Graham will have his own link and be able to pass it over to everybody. But I hope people found that valuable.
Yeah, Jay, thanks so much. As always, super valuable, eye-opening, and yeah, the market's really interesting for it right now. So the timing couldn't be better. Really appreciate you coming up. That's great. So there were some questions. Evan asked, on the first example where the one plot turned 3 plots, bought at 814, and then sold in 3 lots for a total of 980. How was this financed? Do you know this one?
Yes. So in this instance, it was funded on a bridging product by Roma. So we do a fair bit with Roma. They come out to our retreats, as
Yeah.
well, you know. And October last year, when we did our first trading retreat, Scott came out and said, "Well, how do I help more traders or more buyers at auction?" He said, "We already do bridging. We've got a good bridging product. People use it on a regular basis. We've got good market kind of penetration. It's going well." And then I told him a story of this facility that I had in like 2009 to 2011. It was called a hunter's facility or hunter's license.
Yeah. Mm-hmm.
Basically, it was a blank check, or close to blank, a blank check that Handelsbanken had basically said, "You own these assets, you have this income, we will put a levy over those, and then you can draw down," I think it was 75-80% of the value of those assets. And the beauty of that is you have the arrangement fee and the setup fee and one set of legals, but every transaction you do after that is just the interest rate. You don't have to, every time you do a deal, you don't have to go and get it valued and do the legals and do this, that, and the other again. And Roma brought out their revolving credit facility. That's what they're calling it. And that's essentially what we've got this chap to do, who bought this property, he's bought 3 or 4 others. He is using their revolving credit facility. It doesn't impact the lending that you have on the property. If you've got equity, basically what they do is they top slice the equity and then they let you leverage 70, 65, 70% of the equity that you have across X number of assets. They don't put a floating charge. They don't do anything like that. They don't do anything to upset your lenders. But it's a really smart thing. So he used it for that deal and a couple of others. So if you're looking at doing deals and volume and being transactional, the revolving credit facility is good. It will work out cheaper than bridging, but also Roma have a product that enables you to go to term, so you can go from the revolving credit facility to a term exit if you didn't want to trade. But it's a really smart product, so that's how he funded that one.
Yeah, awesome. Yeah, thanks for that. And on the, could you explain a bit more the capital gains tax? You did, but just if you can come back on it, the capital gains tax for trader and the rules that applied for it. When is it exempt, and at which point do you have to pay for it if you hold things for too long and things like that?
So there are obviously not tax advice, not a tax advisor, not a tax specialist, but the property has to be traded, not flipped, traded. So trading is an immediate intention, an immediate intention to buy for the sole purpose of selling. Flipping is normally buying, improving in some way, shape, or form, and then selling, right? So it has to be a straight trade. There is some ambiguity around how long is a trade period, right? If it took you 2 years to trade the property, is it actually a trade, right? That's where it becomes a little bit opaque. But in real terms, if we're buying something and we're selling it within 2-3 months, we're not charged capital gains, because the nature of the transaction, the nature of the business carrying out the transaction, isn't a business that attracts capital gains. it attracts corporation tax, and obviously if we draw money down, income tax. But it's as simple as that. I mean, it's probably worthwhile if trading is something that you're looking at, not flipping. This has to be just trading. If you're looking at trading, it's worthwhile speaking to your accountant or financial advisor to get some more advice on how to structure your trading vehicle in order to be compliant with that exemption.
So I think Christopher I like the idea of not dealing with tenants anymore and wanting to be a trader. So yeah, quite a few of us. And then similar question on stamp duty. So I did, whilst you were giving the example on the probate and the part exchange, I sort of asked my new best friend Claude for the balance of it and paste things in there. But is there more you can add? Because someone's asking a particular case. If I am a property developer and I'm basically building from the ground up, is my development really from stamp duty? And if I sell
Sorry,
it to
I started reading the chat. Can you say that again?
regarding the stamp duty relief, if you are a developer, does this relief apply? If you sell it to your and then if you sell it to your investment company, does it apply? Two questions.
So I mean, there is an element of linked transactions, right? So we already know that there are some exemptions if you own a property in this vehicle and you're the sole owner of that company and you're new to this company. It's considered like a cross-company transfer. So there are ways to kind of manage and mitigate that. On the development side, when the developers are offering to pay your stamp duty when you're buying their unit, it's really only on part exchange terms that they do this. And the reason they do that is because they're not paying the stamp duty when they're buying your property. So all they're doing is it's a sales technique. That's all it is. There's no transfer of benefit here. It just makes you feel like you're getting a good deal because you're not paying stamp duty, but they're not paying stamp duty. So it becomes a net zero effect. I don't know because I don't think Barratt Homes or Redrow or Linden or any of those are, as developers, are doing that to do like a connected transfer. I don't think that's the case. I don't know the ruling on that. It's something only really large scale home builders use on a regular basis, to be fair.
Yeah. Yeah, because if you're a first-time buyer or if you don't part exchange, all of a sudden the offer is not on the table anymore, right? So
yeah, I mean, as a first-time buyer, up until recently, the stamp duty was negligible up to a certain point. But yeah, there's a lot of changes there. Yeah.
Ishak is asking about the Auction Buyers Club. I think he went and have a look, met the criteria on the website. Can you tell a bit more about it?
Yeah, so we started this off in COVID I think 2 months into COVID, because a lot of our clients traditionally would be going to an auction. We'd be advising them on what they were buying or what they would be selling. And then our buying clients had to move from being in a room, an environment that they understood with us, holding their hand, to just being online. And the consultancy fees for us for a day in the auction room are one thing, but if they just want 30 minutes here and now or there, it can become quite expensive. So we put a club together. We invited a bunch of clients to join. It's a 6-month revolving contract. It's a group of a maximum of 24 people. We meet twice a week on Zoom on a Tuesday and a Thursday morning, and we deal clinic. In fact, obviously it's Thursday today, so this morning we reviewed about 12 properties that are going to auction and gave people advice on those properties, on the investment metrics, on the auctioneer, on what the next steps are. Or we told them, don't be a fucking idiot, this is the terrible property, don't buy under any terms. And we tell them that as well, which is actually, I think, we probably save more money in doing that than anything else. But yeah, so that's the club. I think it's £500 plus. It's £3,000 plus VAT every 6 months is essentially the cost of the club, and then we do an in-room boardroom once a quarter, and basically we charge out for that, but just to cover the cost of the room. It's like It's a good community day, to be fair. And we've been running that now for like 5 years and 2 months. It's a big part of everything that we do because, as I've mentioned in the examples, those are people that are in the club doing the deals. It's not an educational environment, the Buyers Club. It's an environment for people to scale up their transactions and have ease of access to us to help them trade and buy and sell at auction. If it's something anyone's interested in, just message Graham and he can introduce us. And then we know that it came through Graham. That'll be lovely.
Cool. Question on back-to-back. So what could you clarify a little bit on the trade? What do you mean? You had on the screen B2B, like, so what did you mean by that?
So a back-to-back is a bit of a unicorn. If you're not a trader and you haven't done it before. So a back-to-back is when you arrange your completion date. Let's say it's selling at auction and the completion date is the 7th of August 2025. So you bought the property here, this is the top contract, you and your seller, you've traded it into auction, you now have you and your buyer, and you need the completion dates to match perfectly for it to complete back to back, right? You and your seller are completing, and you and your buyer are completing simultaneously at the same time. The benefit of that is you get something called the stamp duty sub-sale tax relief. Now, because you owned the property for less than 30 seconds, you were never able to take beneficial or equitable interest in the asset. Because essentially the transaction is leapfrogged over you, you have to complete, it's leapfrogged over you, you don't have to pay the stamp duty. Right? And as everybody knows, the stamp duty is self-certification. You tell your solicitor what to put on that part of the form. But it has to be the same day. If you complete and then your buyer auction completes late the following day, there's no back-to-back. You have to pay the stamp duty. It can be a bit of a risky strategy. So even if you are crafting the perfect back-to-back, always factor in the stamp duty, right? Because either you have to pay it and you're aware you'd had to pay it and the numbers still work, or you don't have to pay it and it's a little bit of the cream on top, which is fantastic.
Awesome. Lee's asking about auction terms, and conditions. How flexible is it? Can you do delayed completion on when the gavellers fell?
So one of the ways, when I said how to structure the flip, right? You're going from auction to open market. One of the best ways to structure a flip in that situation, generally speaking, flips from auction to open market are properties that have gone unsold. Yeah. So let's say the property didn't sell at auction, you approach the auctioneer post-auction and you make an offer. Maybe the price is less, but you're ready to go. But your one condition is that you don't want to complete in 28 days. You want 6 or 8 weeks to complete, right? Because what that enables you to do is it enables you to just get everything lined up even better. And once the property's gone unsold, the vendors are a little bit more flexible. You still have to exchange, it's just negotiating a longer completion. If it's for finance, if it's to get the property cleared, whatever the story is. But you want to give yourself that flexibility, and it just puts you ahead of the game, especially if you're using finance. If you can have the property emptied and cleared and new marketing pictures taken before the mortgage company is even taking their first monthly payment, then you're ahead of the game. And speed has everything to do with this. So it just helps.
Yeah. Awesome. Matt's asking, so someone just asked on this, could you clarify with what do you mean the exchange and delayed completion is based on the auction results?
Auction results. No. So essentially, what I'm saying is, if you're
You can
buying a
only
property,
you can only renegotiate if you didn't sell in auction, and you can have flexibility on terms to the room. Yeah.
So it's a post-auction purchase. So if you're
Yeah.
buying pre-auction or during the auction, the terms are pretty much fixed. There is some flexibility pre-auction, but post-auction there's so much more flexibility because bear in mind the vendor's expectations have been managed. The property has failed to sell. This is a vital point in their transactional process where they just want somebody to come and perform. Now, if they have to give you an extra 4 weeks to do that, they're so much more amenable post-auction. But obviously, you have to negotiate that. You're saying, I'm making an offer on this property for £250,000 on the condition that I have 8 weeks to complete, not 28 days. right? So, but post auction, you can make those requests.
Yeah, awesome. Matt's asking, so Matt's doing lots of short lease deals in South London. So would you recommend not extending a lease before putting the property into an auction trade, flipping it in auction?
I mean, Matt will know this. Obviously, they've done away with the 2-year notice. That 2-year wait is gone. That makes your life so much easier. One of the best ways to add value to a short lease property isn't to extend the lease, it is to start the process of extending the lease. Finding out, submitting the Section 42 notice, getting the return notice, getting a confirmation of what that extension cost is, and then putting it into auction. And the reason you do that is because some people don't like buying it because they don't really know what the cost is. Uncertainty, unknowns reduce price. Certainty and knowns increase price, which is why a property that has PD or planning permission sells better than a property that doesn't, because now there is certainty over what can be achieved. So you can just start that ball rolling, serve the Section 42 notice, put it into auction, or wait for the return notice, put it into auction. That's just a great way to, that could fit a 3-2-1 model very quickly, right? There'll be some way actually my return, if I do the lease extension, refurb and put it on the open market, this is a property that's in Knightsbridge or Greenwich or whatever, that return is going to be higher. But if it's something that's in East Ham or West Ham or somewhere like that where the return is going to be a little bit more marginal, then just get in and out quickly.
Yeah, cool. Question on recommendation for bridging lenders. So you mentioned Roma. So it was Scott, yeah.
Yeah, so we use Roma quite a lot, and they're kind of our go-to choice for the buyers club as well, because they're so kind of ingrained in what we're doing. If they're slow or there's a problem, we're able to jump in and get things moving. It can happen with bridges, even really good bridges. And we work with a broker as well in case what we're getting somebody to, or what someone's buying is outside of the Roma wheelhouse. And they just have a third-party person that they can recommend to us. But at the moment, pretty much everything goes through Roma.
Okay. You still pay auctions after? Sorry, do you still pay auction fees when you buy after the room?
So yeah, so the auction fee, these are things. So what's not negotiable is the auctioneer will charge you £1,200 plus VAT, for instance, say something like that. You'll still have to pay that. That's a fee that they charge to buyers, because everything up until that point is free. Accessing the legal pack is free. Going to the viewings is free. All of that stuff, calling them up, everything is free. The only thing that you pay them if you win the property is the buyer's fee. Now, if there are fees in the legal pack, you can approach the auctioneer and say, actually, the fees are a bit heavy in the pack. Would they agree to, instead of 4,000, would they agree to 1,800? Right? And it's a negotiation point that you can use. And if you're trying to cut the fees out of the pack, asking for a longer completion won't work. So you almost want to be like, well, if you take these fees out of the legal pack, I will complete in 2 weeks, right? Because what you're offering is take this noise out and I will give you the speed and certainty and time that you absolutely need. So again, it comes down to finding out what the motivations of the seller are rather than what's ideal for you. Because all of these things, it's a sliding scale between how much you're paying and how much costs there are. And you just have to move those parameters until it fits the price you're happy with.
Yeah, awesome. Someone's asking about how do you sort of assess the value of a property? Where do you go to do comparables and stuff like that?
Yeah, so I mean, a lot of what we do, the first step is we go on EIG, Essential Information Group, and we have a look and see, if the property's been on the market before, but we also have a look and see if anything on that road or within the neighbouring roads has been to auction and how that performed. We will also go on to property data, because we use that for just a basic due diligence. We mainly buy commercial property, so we have a CoStar membership, so we can look and see all of that data, which is immense. But we start very basically with the full address of the property, going on Rightmove and Zoopla and looking for comparable evidence, how long it was on the market for. And we've got this Google extension called Patma or Patmal.
I'll show you how property filter works, mate. You know, 'cause I'll
Yeah.
have to show you.
And basically it shows you every time there's a price drop on Rightmove. It doesn't like alert you, but if you're looking on there, it'll say, oh, it was first listed for X and it was reduced to this, or it's sold and came back. Nowhere near what Property Filter does. It's kind of like a little so it's just a tiny little side box. So we have a look at that as well.
But yeah, but basically it's the usual thing of looking for comparables, right? It's like what is close by and close by in size and condition to what you have, and then it's taking a view, you know. So I think people expect clicking a button and get the valuation. It doesn't. None of these things really work, you know. So it's a skill you get used to the more you do it, and you become quite, you know, confident with it. It's looking at the comparables and taking a view, you know, and I think. You know, if you send 2 RIC surveyors to value a property on behalf of your bank, they'll be within 10-15% of each other, you know. So don't waste your time trying to know what this property is worth right now to the nearest pound. It doesn't matter. You know, you're going to buy it with such a margin that if it's, you know, if you buy it for 160, you don't care that it's worth 178 or 188, you know, who cares, you know?
It's really it's especially if you're an investor or a flipper, what it's currently worth now is immaterial. It's what it would be worth when you sell it out or you refinance. You know, once you've done works to it, that's the real figure.
Cool. Let me see. When underwriting, you mentioned that you need to pay the 10% deposit, and then you're required to pay another 10% deposit when you exchange. So this is in the case. This is in the case of you bidding on the property as well.
So this is very specific. Yeah. So if you underwrite the property, all you're paying is the 10% deposit. If you underwrite and do nothing else, you're paying the 10% deposit and the auctioneer's buyer's fee, which generally speaking, it's £1,200, right? If you don't win the property, you get that deposit back as the underwriter. You get the deposit back and you get your uplift. Now, Lee, what you're saying here is if you underwrote it at 250 and then you bid up to 310, you'd have to put down a 25% deposit, £25,000 deposit here, and a £31,000 deposit here, right? Because these are 2 separate contracts. One's an underwriting contract, one's an exchange of contracts. 2 very different things. If all you're doing is underwriting, you only need the one deposit. If you're underwriting with a view of kicking the bidding up, then it's a different story. Then you'll need the 2 deposits. But keep it simple, just underwrite and let the market figure out what it's worth.
Yeah, and then you'll have on top of that the auction fees. Yeah.
So if there's anything in the legal pack, those aren't specific to underwriting. That's specific to the asset. So you'd have to evaluate each asset separately.
Underwriting, just underwriting. Do you have to pay some fees? Or?
No.
Okay.
There's no additional cost to underwriting.
Yeah, it's interesting. Some questions around someone trying to be a bit clever. So I'm trading this property, this probate property over here, but I'm trading it to myself. Can I then save on the stamp duty and things like that? So you mentioned about linked transactions, and
I think there's a question around that. The reality is because we don't do that, I'm not entirely sure how it would play out. Everything that we buy, we're selling to an independent third party at an arm's length, and it works. We've never had any problems. So and here's the thing: why would you want to do that? Why don't you just buy it in that end vehicle anyway? Obviously, because you want to retain it, so you won't get the stamp duty exemption. Okay, that's fair. But no, I think if party A is buying it and is connected to party B, someone's going to have to pay stamp duty somewhere along there. And I wouldn't complicate it.
And then if you sell it to yourself, you have to. The other company needs to. It's not part of this initial trade, so you have to pay the stamp duty over there anyway. So.
Yeah, and you're probably going to want it to sell for more to that second company. So it'll be you're yeah. There's no point doing that.
Yeah, awesome. Quick, then last one for Kieran was asking, do you know like the sort of cost from Roma? Top of your head?
Well,
Oh,
in
my
short, the
camera.
answer is no, because I know that. I mean, the bank has
It
just
changes
reduced
all the
the
time, innit? Yeah.
base rate, so it's always moving. But I've always found them easy people to talk to. So just like reach out,
Yeah.
tell them Jay said to say hello. I'm not financially rewarded for
Yeah.
recommending them. So
Yeah, they're very good. Yeah.
yeah.
No, that's been great. That's been awesome. So there's lots and lots of questions as well. So that was super valuable as always. Always cool spending some time with you. Have you got some like a closing sentiment for us?
Um,
Throwing you
auctions
on the
have
bus a
doubled
little
in
bit,
size. Yeah, I just took a deep breath there. No,
Yeah.
auctions have doubled in size. Um, they are now between 8 to 10% of the market. To put that into perspective, in 2019 they were 2% of the market. Auctions are huge. At the moment, the number of lots that are being sold in and around summer is crazy. The
Mm.
number of deals that we're in the process of working on 2 deals to exchange this week that have gone unsold at auction. So we take our own poison. This is exactly how we operate. Would we have got these 2 deals where they are now a month ago or in 2 months' time? No chance. They would have sold for too much money.
Yeah.
Investors have started to get back into the old habits of going away in the summer and not looking at the auctions, which means things are selling cheap or they're not selling at all. But it doesn't mean there isn't tons of stock out there. And you're dealing with motivated sellers. These are people who have a real time motivation: debt, death, divorce, discretion, all of these
Effect.
different types of distresses. They need you to transact. Okay, they have to offer you a discount to do that, but you have to be able to perform. And performance, speed, understanding your numbers, I think that's what I'll leave you with. It's just so important. And think about trading as an option. If that makes you less reliant on debt, or it means that your refurbs are cheaper, or you have bigger deposits to do bigger deals to take that next step up, that's what flipping and trading can do for you. Just a different way to kind of look at accessing the market and profiting from real estate.
Yeah, awesome. Really appreciate it, Jay. As always, thank you for your time. You've been really cool. We've went a little bit over, so thanks so much. And for everyone, so up until when we got this course for? Is it like until next month or something?
Yeah, so it'll turn back into a paid course on the 30th of September. So,
Yeah,
just register today.
yeah,
It is absolutely free. It takes less than 2 minutes.
yeah. I'll go on it as well. So thanks so much. Really appreciate it as always. And if you want to check out Jay's YouTube channel, it's full of really good golden nuggets as well. And if you're not, so when you join the Property Filter Plus, we send you a shipment in the post with swag. And Jay and Piotr have been really generous to give away their book. So we send you their book as well. And if you're interested in auction or not, again, I do believe it's the best book out there for all things to do with due diligence. And I don't know anyone that's written it so well for that. So for me, it's a reference. So everyone should read it, and we get it given to us. Yeah, it's really good, really cool from Jay and Piotr. Thanks so much again for your time, and thank you everyone for joining today. Looking forward to speaking with everyone soon. Thank you. Bye bye.